Hello traders. So getting a few questions on the oscillators that I utilize and why I use these oscillators. Now, before we get into the oscillators, I just want to make something very, very clear. All my strategies are based on moving averages. I use three basic strategies. One is the Bill Williams, one is the Ichimoku, and one is my own strategy, which is a moving average crossover strategy. There are individual videos on each one of those strategies, which I will put in the comments below. Okay, but the primary area that I'm interested in is levels. Okay, so if we are at a level, the oscillators agree with the level, I'm with the trend, I place the trade. It's as simple as that. Okay, so part of the levels is fractals. Fractals are a key part of my strategy as well, which also indicate multiple different levels. I'm going to use this, just a quick one here as an example. Pretty much this is a level and this is the level. Okay, and if we look at what happened yesterday, we came down, tested the one level, didn't quite get to the next level, and there's a third level in between, which is a 200 moving average, and we bounced off it, and bounced off it we did. Okay, now we're talking about the oscillators here. Now, the two oscillators I use with my Bill Williams theory is the Williams percentage R or Williams percentage range and the awesome oscillator. Okay, awesome oscillator and the Bill Williams theory go hand in hand. So long as we are above the zero here on the awesome oscillator and we have green bars, we are trending up. Okay, now you could actually do away with this oscillator if you really wanted to, but I do use it to indicate when a trend is coming to an end. Okay, it helps me because then I start seeing these red bars. It means momentum is dying and we're starting to head to the downside. And you can see, even though the trend is still up, because we are above the zero and we're also above the alligator, we are still, momentum is dying. Okay, and eventually we drop below, bit of a trend change here, rallies down for, well, pretty much after hours and then accelerates up. Okay, anyway, so the Williams percentage R, I use multiples of 3 for my settings. So it will range from sort of 6, 9, and 15. Those are the three settings I'll use. When we are ranging, pretty much like that, and I have time, I will be down at a 5-minute chart. Okay, there we go. There's our range. I'll be at a 5-minute chart, and we'll actually change this down to a 6. I'll show you what I mean. So if I change that setting to a 6, I get pretty strong entry points of where I can buy and sell when we are range bound. Okay, but the default setting that I predominantly use is either 9 or 15. Okay, so I'm on 15 at the moment because we are in a pretty strong point, and even at the 15 you can see groups the bottom, groups the top. Okay, so the Williams percentage R is a momentum index. It indicates overbought, oversold conditions, same as a stochastic, same as RSI. Okay, and you can use a similar theory with any one of those oscillators. Now, the most important thing about the Williams percentage R, it is not to be used on its own. None of these oscillators are to be used on their own. They are just another verification for you to see if you've got the right entry point. Okay, and if I just take what's happened here as an example, we ranged, it looked like we'd broken through, we've got a trend reversal here. Okay, but my levels are the key to everything. Okay, so it's only when we start breaking through those levels that we can get some confirmation that we're moving to that we've changed the direction. Okay, so this works across multiple assets. It works on currencies. So 30 minutes, let's just get currencies, although you want to try get a higher time frame on them because they're so volatile. But you can see pretty much gives you the indication of where you need to buy and sell. And if you look at, what is this? This is the USD Swiss franc CHF. You can see we are bouncing on a level here, and everything is indicating that there's a good potential that we're going to be moving back the upside. Okay, If you look at the Euro USD, okay, very volatile. That's why you want to be on the 4-hour. You can see oscillators grouping. Let's just come back to here. So you can see on the currency perspective, you can see moving to the downside, but you can see warnings are ringing here. You're looking for levels, and it'll break through levels, and now it's found some level here because you can see these tails at the bottom here. So there is potential that this is changing. Okay, the awesome oscillator, I've got separate videos on that as well, but essentially it's also a momentum index or a momentum indicator, which is telling you whether we're in a trend or we are ranging, or the trend is kind of about to reverse. Okay, and basically the zero line is across above and below that. Okay, so let's just look at another strategy that I use, which is my 927 strategy. Now again, this is a moving average strategy. It's based on a 9 moving average, which is the blue, and a 27 moving average, which is the red. Again, multiples of 3. Okay, this strategy is a little bit different. We do have the Williams percentage R in place, but I also have 2 stochastics, and the stochastic settings are 955 and 2755. Again, multiples of 3. Okay, now stochastics and the Williams percentage R are both momentum index oscillators. Okay, so they've both got overbought and oversold conditions. But when they are both grouped in over to the bottom, okay, so if we're looking at oversold conditions here, and I'll just put a level here so you can see what I'm referring to. Those 2 blue lines now are, for the Williams percentage R, is -80, and for the stochastic, that's 20. Okay, so you can see here, Williams percentage R drops below -80, but the stochastics are not there. So that's not a valid buying point. Second point around this is that is my level there. Okay, and I'm going to put this in. I'll move that line. Okay, so you can see that is an indicator that we're coming up to a buying opportunity. We're not at a level yet, so there's no buying opportunity there. We drop back below, okay, there, and we're hitting this level. But look at the stochastics. Stochastics have grouped in a buying area, and we are at a level, okay. Remember, a level is never exact. Sometimes it hits exact, sometimes it bounces just a bit short, sometimes it bounces a little bit low. But the point is, that was my buying opportunity. Now, buying opportunity at the close of a day. I don't know if you can see these dotted lines. There's one here, and there's one here. End of the day, we're getting a buying opportunity. And there were some buyers that stepped in. And quite a few buyers that stepped in, actually. Okay, and you can see it continued rallying to the upside. Oh, sorry, I'm lying to you. We're on the 4-hour chart. These dotted lines are weekly, not daily. So this is 1 week, and this is another week. So towards the end of the week, we got a buying opportunity. Next week was a rally of note. Okay. And you can see we got a little bit of a warning here because now we are in the overbought territory. Okay. Overbought, double top. Okay, we're looking for a pullback. We got the pullback, and then we got this set up here. Okay, now these oscillators here pretty critical because we are below the -80, so we are oversold, but the stochastics are not agreeing, but they are far apart. When you get the slow moving stochastic down the bottom and the fast one near the top, that is also a valid signal. Okay, if they're all over the place like this, it's not really a valid signal. But when you've got them far apart like this, you can see how these 2 lines are moving apart, those 2 lines are moving apart, and this oscillator's there. That is a valid signal. Okay, and again, off a level. There's my 1 level, and in the videos I was looking for that level, which is probably a bit optimistic. Should have actually taken that level. But nevertheless, you still could have got in on this trade because you've got two levels here that you're looking at, and you pretty much could have taken a 50-point stop loss below this level here. That will give you 100 points off the first level. Anyway, that's a different discussion around risk management. So that's how I use this strategy. So pretty much I'm looking for moving average crossovers to confirm the direction. I'm looking for the oscillators off a level to indicate my early entry. Okay. And as soon as I start getting to a level and the oscillators are grouped to the upside, that would be my signal to get out of it. Okay. So that's kind of how we use the strategy on this instrument. Now, if I go to a currency, again, USD, Swiss franc, you can see as soon as these stochastics group to downside off a level, and in this case, for our chart, the level is the 200 EMA. You can see the tails off here. That's a buying opportunity, and you see there, my selling opportunity. They're quite far apart. Get out of it. Comes back to the bottom, group nice and tight. Another indication for a long. Okay, and again off a level. And levels for me are the 200 EMA plus any inside tails that I may find. Okay, but again, that's a separate discussion level on levels. If we just look at gold, you'll see, okay, I'm on the daily for gold. If we go to a 4-hour for gold, you'll see the same kind of thing. Okay, and sometimes you get a grouping in the middle of nowhere, which is not a valid signal. It's more a case of that you're ranging, or we've been ranging for a long time. But if you look back in history, you'll see there's a grouping, and up we move. And you can see the moving averages confirm the trend, and we stay with the trend. So the last template I use is pretty much the Ichimoku, and we'll take this off the Dow, start with the Dow again. Okay, with the Ichimoku, I'm using Williams percentage R on the 9, and that just lines up with Tekinson, which is the blue line, because that is a 9 moving average, and the red line, which is Kijinson, is a 26 moving average. Okay, so I suppose it's not really a proper moving average because there's a little bit more in the calculation of that moving average that goes into it, but it still gives you the indication of the trend. Okay, now with this, it is very simple. Ichimoku, so long as you're above the cloud, trend is up. If you're below the cloud, trend is down. Cloud is this area here. Okay, so again, levels play a big role, but when you are below the cloud, you're only looking for selling opportunities, and whenever the Williams percentage R gets into this area, you want to use this on a higher time frame. So this is a 4-hour time frame, much longer trading. If you look at it on the hour, it does also work, but it's just a little bit more volatile, and you stress yourself out a little bit more. Okay, so try and stick to the 4-hour with this. Rule of thumb stays the same with the Williams percentage R. When you group to the downside and we are above the cloud, it's a buying opportunity. When we group to the downside below the cloud, look for the levels to get out of it, wait for the oscillator to rise again, normally to come and test the cloud or get closer to the cloud, and that's your opportunity to get short again. And the converse is true when you are running. So here you can see we are sort of above the negative 20 here. We're above the cloud, the trend is up. So long as we're staying above the cloud, the trend is up. And you can see you're getting some warnings here that this is getting tired. It's a little small pullbacks, not big, small pullbacks. And then you're getting buying opportunities. There's a big buying opportunity there. There's another buying opportunity there. Okay. There's another buying opportunity. There's another buying opportunity. There's another buying opportunity. This is a massive buying opportunity. Okay, bear in mind we're on the weekly. Sorry, we're on the 4-hour chart, but these dotted lines are the week. And you can see double bottom on the oscillator, buying opportunity off the bottom of the cloud, always a good opportunity, and up we go. Okay, and then yesterday you can see quite a big buying opportunity right there. Okay, off Kijinson, which is moving average, off a level, there's my level there, all tying together, and the oscillator to the downside. That's a buying opportunity. Okay, so in my earlier videos, you'll notice that I use the MACD and I also use the RSI combination with the stochastics. That is also something that works, but since those early videos, I've actually refined the process to focus more on the level and make sure that my entry and exit points align with a level as well as a oscillator. So the oscillator is giving me a signal. So I've got a signal, I then have a level, and the trigger will be a pretty much price action, and it'll be something like pin bar, engulfing bar. So you've got, let's do this properly. So we've got inside bars, there's an inside bar, there's an inside bar, so that's a trigger for a short, that's a trigger for a long, inside bar, trigger for a short. So I've got an inside bar, probably a level up there as well, and also the oscillator, which indicates a pullback. We get a pullback, and then we get inside bar for move up. So I do have separate videos on that as well. So I'll try and group all those videos that are relevant in the comments, and that'll give you a single point of reference. Okay, so those are the three basic oscillators that I use. And I think just coming back to the 927, the stochastics here is always a nice one. I think this is probably my favorite trading strategy for myself. Okay, so I do use this quite often, although the daily reviews are done with the Bill Williams theory, because the Bill Williams theory is something which a lot of people understand and follow, so that's the only reason I'm using it there. But I do, in my personal trading, I often switch to this 927 moving average strategy with the stochastics, because the grouping of the stochastics always, especially when they start getting tight like this, and it works on any time frame. I mean, I can go down to a 3 minutes, and you'll see when they group like that, there's a buying. It groups the top, there's a selling. Sell entry up there, and then you can see for as long as we're staying below these moving averages and we don't cross over, it's a short. And the converse is true when we're moving to the upside. And I'm just going back to yesterday. You see the whole morning was down, 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 then up, and we just maintained this trend all the way up. Okay, so that's pretty much the simplicity of the oscillators that I use. And as I say, you can see multiple time frames. You can see how the stochastics group up or down, and they can stay grouped for a long period of time, especially on the lower time frames. Okay, so you can see here's 12 minutes, we're grouping up, but it doesn't necessarily mean you need to get out of the trade. All you do is you just keep moving your stop up below a fractional level. Every time you form a fractional, like there's a fractional, move a stop up. There's a fractional, move a stop up. Another fractional, move a stop, move a stop, move a stop, move a stop. Okay, and that way you can stay on the trend so long as you're above these moving averages. Obviously, what I do like to do is keep the 1 hour and work off the 1 hour. So there's a good entry point for a long, and here is a good point to start looking for an exit. And if I just summarize that exit, that I can almost guarantee you there is nothing here except for there is a level there. You can see there's a lot of stuff happening here. So you would expect that this could potentially be a exhaustion bar. Okay, and it could be a weekly exhaustion bar as well, because it's a weekly level. And you can see from a weekly perspective how the Williams percentage R is now horribly overbought. Okay, but the stochastics is not quite there yet. And if you look at the weekly, you can see how you had a grouping here, moved down, a second grouping, double top, short. Okay, so anyway guys, that's it. So just bear in mind, oscillators are not a trigger on their own. So they just give you a signal. Your trigger is based on price action and levels. And whatever you do, make sure you're using some form of a moving average to help you stay on the trend as well. Anyway guys, I hope that helps and clarifies how I use the oscillators, and I'll catch up with you next week. If you haven't subscribed, please subscribe, and you'll see we do a daily video on 3 instruments every single day of the week, giving you the entry points for the day. Anyway, that's it for me. Enjoy the day, enjoy the weekend, and I'll catch you later. Cheers.